Well, absolutely. I don't think this is the time to celebrate a win. Well, let's celebrate the win, but it's certainly not the end by any means. I hate to use those four of the most dangerous words in the investment lexicon. That's what John Templeton said, but this time is different. Um, what we've seen is obviously everybody knows, but I think it's important that we really focus on the implications. Everybody knows what's been driving gold for the last 3 years. Central bank buying to diversify assets in the face of dollar weaponization. More recently, Chinese buying has come in non-official. Chinese non-official buying has come in because of concern about the yuan and concern about the economy there. So they want to protect their wealth against the devaluation. And of course, concern generally among more generally wealthier individuals, families, Middle East, Far East, as well as Europe, and to some extent the US, about the fiscal situation, not just in the US, but frankly, worldwide. There's very few countries you can point to, very few major countries you can point to and say they've got their fiscal house in order. So all of these things combined, and we know all of that, but what's important, I think, is that what I'll call the traditional reasons that people have bought gold, not as an insurance, but the reasons people have bought gold as an investment, that is the macroeconomic environment and factors, simply hadn't been present. I mean, we've had, and I'll say apparently once, but we've had an apparently strong economy. We've had high interest rates. We've had low inflation. We've had a relatively strong dollar. I mean, can you think of an environment, an economic environment that is worse for gold? And so, because of that economic backdrop, people in the West and regular, ordinary investors have not been investing in gold. They might be accumulating it for insurance, but they haven't been investing in gold. And that's also the reason, in my view, why the stocks have not, until very, very recently, exhibited any of the leverage that we associate with gold stocks over the metal itself. Because again, the macroeconomic environment has not been conducive. And if every month you're an American investor, you're a Canadian investor, every month you open your brokerage statement, whether you open it from an envelope or online, and the bottom line number goes up pretty much every month, the TSX or the S&P, with few exceptions, you don't think about diversifying away from, the S&P. And so I think there's a logic, frankly, you didn't ask this question, but I do think there's a logic as to why the gold has performed over the last 3 years better than the gold stocks, or at the minimum, the gold stocks have not given us leverage. Now, when you say, I forgot what your question was. Sorry, but you didn't ask me about baseball innings, did you? But is it a time to celebrate a win? I think absolutely not, because the economic environment is only now beginning to turn in gold's favor with signs of a weakening economy, weakening dollar. The Fed is going to have to cut interest rates at some point, although they obviously are reluctant to do that. But at some point this year, they're going to have to, if only to help the federal government fund its debt. So basically, I think, and this might surprise you, I think we're only just getting going with what I'll call a normal gold bull market.
Now, Adrian, it's funny you mentioned baseball in the context of gold because I actually have an interesting anecdote I can tell in relation to that. So last night I'm sitting down and I'm watching the Blue Jays game. They were playing, I think it was St. Louis, and I noticed something very strange that I've never seen before during a Jays game. And that is that they put graphics up on the back of the mound. It's usually like Ozempic or something that your everyday person is going to buy. You know what was on the mound yesterday as a graphic that I've never seen before?
Costco.
Stiefel.
Oh,
Stifel, a junior investment bank, was advertising during the Blue Jays game last night.
no.
And then this morning I wake up, Aya Gold and Silver, or Aya Silver and Gold. I always mix them up. They announced $100 million financing, and I didn't see that coming. I mean, I like the company. Benoit is always a great guest on our show, but that's a big financing. And every day, as a company, we go through all the financings that exist in the Canadian junior markets, and there's just more and more of them every day. They're getting larger and larger. I think Stifel just did a whole bunch of bought deals, by the way, and then perhaps that's why they're out there doing that advertising. But I think that we are now, it's officially on. We're officially starting to see capital come back. The Canadian junior investment banking sector was actually really hurting for the last 3 years. Canaccord laid off most of their capital markets desk from at least from the old cannabis days. That's what I was hearing, is a lot of people lost their jobs. 8 Capital, which had turned into one of the larger investment banks in Canada. I know it's still basically just a boutique shop, but they basically disbanded, and I think that their top guys, they went and joined Stifel. But it's shrunk considerably, and now all of a sudden we're seeing them advertise during Blue Jays games, and there's only one reason for that, in my view, and that is that the relievers warming up in the bullpen, and they're getting ready to come out and start selling gold stocks to those institutional investors and those high net worth individuals. You think that it's a good sign, or am I making it out to be too big of a deal?
No, you're not making out to be too big a deal at all. Now, frequently, when I see lots of companies, especially juniors, come out to raise cash, it says to me, maybe this is a short-term top. That's the immediate reaction I normally have. But I mean, I think on this occasion, I think it really is a sign that there is just increased interest among investors. You're absolutely right. I mean, a lot of these deals that have come out in the last month could not have been done, even if they were trying to raise half the amount of money, a year ago. It simply couldn't have been done. And what we're seeing now, like Aya Gold you mentioned, but that was oversubscribed. I don't know if you noticed that. We're now seeing companies come out who maybe need 4 or 5 million, but they're aiming for 8, and they're finishing with 12. So that is a sign that money is finally available and coming back to this sector.
So I heard an analogy once from a guy who's been on Bay Street for decades and decades, and I don't know if he wants me to say his name, but it was a quote that really resonated with me about the Canadian junior markets. And he said, "The thing about here in Canada is that we are we're the last ones to arrive at the party, and we are the first ones to leave." And that's something that goes through my head a lot now when I think about the context of how capital flows, and if you're investing in this space, how you have to know when to take your chips off the table. Otherwise, you get stuck in something, and it's really hard to exit. You think that it's different, though, when we talk about precious metals, given what Canada means in terms of commodity capital markets?
Yeah, I mean, the Canadians generally, what I call a regular Canadian investor, certainly is more knowledgeable and more insightful into the resource business than, let's say, the typical American investor or British investor for that matter, because it's just such a big part of the economy, it's such a big part of their history, and they're much more familiar with it. It's interesting because, again, what to say this time is different is very, very dangerous. I mean, I know that. But I think we're only just beginning to get investors coming into this market. I mean, typically, some of the things that we've been talking about, you would think, oh dear, that's a sign of late stage distribution. The insiders are getting out and they're flogging their paper to the masses. I call it gut, call it my experience, but also call it, some of the factors that I've mentioned about the economy. I think regular investors are only just beginning to get into this. And when I say regular investors, I'm not talking about just retail. I'm talking about family offices, small institutions, RIAs, etc. They're only just beginning to get into this market. I don't think we're anywhere close to the end.
I I I agree with that, and also the RIAs, or I guess the term is investment advisor here in Canada, which historically is what I guess you would have called a stockbroker. We still have stockbrokers, but I hardly know anybody who has one anymore. Um, that's just for our audience. Who's most people I know who are under 40 just use discount brokerages and buy ETFs, so they don't even know
Sure.
what most of these terms mean.
When I say to
But
people, just call your broker, they say, how do I do that?
yeah. Yeah, I mean, I've got some pretty affluent friends that have done well for themselves, and they don't have a stockbroker or an
Yeah.
investment advisor. They just, oh yeah, I'm gonna buy this ETF. Why would I pay those fees? But I think that that's interesting because it's like when you think about it in the context of where a lot of the wealth is, it's in people who are over 60 years old. A lot of them do have investment advisors. And if I were an investment advisor and I was watching this right now, or I was thinking about portfolio management, I'd be thinking, yikes, if these gold stocks continue to show momentum and have a bigger move, and let's just say Barrick or Newmont or Agnico Eagle or Kinross, I don't care, pick whichever one you want, a basket of them are up 3x from here in the next 3 years, I'm going to look really foolish if I didn't allocate my clients to have some exposure into these gold producer names. And I think you're exactly right that hasn't even started yet.
Right. And it also works the other way around, particularly in the States, where most investment advisors aren't familiar with gold, the gold sector at all. Yes, they've heard of Newmont and Barrick. Some of them may have heard of Agnico, and that's about it. But it works the other way around. A client will call his advisor and say, hey, I've been hearing about gold. I think I should have some gold. And the advisor sort of says, if you really think so. And what does he do? Typically, he buys a GDX. He doesn't even buy individual names. And that's another sign of what I'm saying. You go back to the middle of May, for people your Canadian people who may not know, but GDX is the largest gold miner ETF. So you go back to the middle of May, there were only 3 days this year, 3 days with net inflows into the GDX, $3.3 billion of outflows, net outflows. That is a sign, again, that's a sign to me that RIAs are not, investment advisors are not in this. The sort of people that buy the GDX, the guy that says to his broker, hey, I want 1% in gold, buy me a fund. They don't pick individual stocks. And that to me is a sign of what I'm saying, but it's only just beginning.
Speaking specifically of some of these miners, a question that I've been asking a few of the more high-profile guests we've had on recently is about Newmont's decision to unload a bunch of assets. Here we are in a raging bull market, and what does Newmont do? Well, they made this announcement, I think, about a year ago that they were going to unload various gold-producing assets. They set out to sell, I think, I forget the exact number that they were planning to sell. It's something like 6 to 9 or something. And they were planning to sell them for $2 billion. They ended up getting $4 billion, and they didn't even sell them all. Now they're saying that what they want to focus on is what they define as tier 1 gold assets. And they don't deem these assets to be projects that are a part of that mandate. Do you think that this is the right move by Newmont, or do you think that they're going to end up looking a little bit foolish for unloading their lesser quality assets?
No, I don't like Newmont. I'll start there. But in this case, I do think it's the right decision. I mean, they spent a lot of money buying Newcrest, remember? And so part of that decision was to sell some marginal mines to reduce the cost of buying Newcrest. And Newmont's not the only company doing this. Barrick as well, as you know, both has sold some small mines, including the Donlin. They're interested in the Donlin, which they've had for, well, at least 10 years now, probably more. And they're also trying to sell some other small mines, both in Africa and in Canada. I think there's a logic to it when you've, in the case of Newcrest, Newmont, you've just bought Newcrest. You've got new mines, big mines that you acquired. You want to focus on. In the case of Barrick, you've got a couple of really big construction projects underway. including Ragadik in Pakistan. So getting rid of marginal things, to raise cash, but I think more importantly, to avoid the distraction. Because let's face it, if you're Newmont or Barrick, a $3 million ounce mine is pretty small. And you're looking at mines that are producing 250,000, 500,000 ounces a year. Well, the top management will spend as much time on the small one as they do on the big one. And that just sort of doesn't make sense. There's only limited people, limited time to focus on assets. So you want to focus on the best.
Let me ask you this then. You said you're not a huge fan of Newmont. If you were told that there's one gold stock that you could pick, and based on a very, very, we'll say, for a risk averse investor, let's just say somebody like my mom, for example, if she asked me, she says, Steve, what gold stock should I buy? She wants some sort of torquiness to the upside, but she wants something that's not overly risky. Which stock would you recommend?
Well, you may disagree. For that investor, I would definitely say the big royalty companies, Franco or Wheaton. I know the two arguments against them. The two arguments are they're overvalued and they don't give you leverage or torque in a rising gold market. I think both of those are wrong. The valuations are they're no more expensive today than they were 5 and 10 years ago. And I think the high valuations are justified because of the low risk model. When it comes to torque, if we have a good gold market for 3 or 4 years, think what happened, from 2009 to 2011 or 2001 to 2007 or whatever, 1976 to 1980, you will do just fine, just fine with the most conservative stock out there. So what I'm saying is if you buy Franco, yeah, it won't be the best performing gold stock in the next 3 years, but it certainly won't be the worst performing. And a conservative, older investor will feel very, very happy with the returns that they get.
So why is that? Mathematically speaking, is it just because when you own a royalty company, you don't have to worry about all of the operational risk of things going wrong, and you kind of just get to you just get to sort of eat the cherry on top without having to worry about all the headaches?
Sure, absolutely. Look at Franco, for example. When the Panamanian government shut down Cobre Panama, Franco-Nevada lost about 19% of their revenue. That's meaningful. First Quantum lost 30% of their global revenue. But First Quantum is spending $13 million a month just on care and maintenance on that mine. Franco's not spending that. When the contract is renegotiated with Panama, it's First Quantum that's going to be making concessions. Franco-Nevada's just waiting for that to come back on, and then their stream starts again. So that's the beauty of the model. The second beauty of the model is that on a negotiated royalty or stream, Franco, Wheaton, whatever, they will always negotiate a royalty or stream on as much surrounding ground surrounding a mine as they possibly can, right? That's typically very, very inexpensive because it's basically just barren ground. Well, not barren, but it's not, there's been no drilling, there's been no exploration, it's just ground around the mine. Now, when the mine comes into production, 10 years later, it's now in the depletion state, and that mining company, whatever it is, starts doing brownfields exploration around the mine. Who's spending the money on that brownfields? The mining company, not Franco-Nevada. And when they start doing greenfields 10, 20 miles away, who's spending the money? It's the mining company, not Franco or Wheaton. And yet, if they find a deposit and add those ounces or pounds, whatever metal we're talking about, and add that to their existing mine, Franco gets the same benefit of the royalty. So I call that leverage. They get that in 5 or 10 or 15 years, they get those additional ounces without having spent an extra penny to generate them. I call that tremendous leverage.